3 stocks, 3 charts, 3 trades. Rick Ducat takes us through the charts, and here to take us through the trades is Alan Nuckman, Chief Market Strategist, BullseyeOption.com. Thank you both for being with us. So the first one, you're looking at old school tech, right? I mean, that's what you called it. I liked that. Oracle is the first one on your list, Alan. Why is that?
Well, when I was a young trader, before these FANGs came into play, these were the stocks you used to look at. And what I like here is I like tech from risk reward, and I think these have been out of favor. So this sets up, my optimism wins strategy that I don't think the markets are different this time. I think we have a lot of positives to build on, and I think these are good stocks that have great risk reward at these levels. I mean, if you look at the overall market, everyone's very concerned. It's only been a month since all-time highs. The S&P is 5% off its highs. The NASDAQ is about 12% off its highs, and it hasn't recovered to the halfway point where the S&P has yet. So I think you could see a rotation into some of these tech stocks as the S&P, we're looking at a 3-week streak of strength and a reversal bottom.
Right, and you know what? We haven't seen 3 weeks of strength in general, 3 weeks of gains since last November for stocks. So this week could be a monumental week for us, record-setting in its own way. Rick Ducat, your thoughts here as you take a look at the Oracle chart.
Well, Oracle has made an interesting move recently because it had been in a kind of sharp, long downtrend since last earnings. So more recently, Oracle has been kind of pushing sideways through this trend line that we have drawn here near point A on our chart. So looking around at this, I decided to put a volume profile and the volume average on our charts here. So just to give some quick introduction, volume average, that's just our normal volume. It's showing when trading took place. Volume profile is that blue bar graph on the right side of the screen, and it shows us the important price levels at which the most trading took place. So point A, we're in a smaller volume node. That's what these areas of heavy trading are called. And we're right near both our yellow 21-day exponential moving average and our 252-day. So price hasn't really, even though we are breaking out of this downward trend, we haven't really formed any kind of interesting uptrend or any kind of breakout or anything yet. So if that does start to happen, look for the red line there near point B. That's the volume profile point of control, which is near about 90. To the downside, look for that other larger volume node just below 80. One final thing to point out, volume has been very light during the past couple weeks. Take a look at point C down there. Very, very noticeably below our 50-day moving average of volume.
That's very interesting. What a great chart that is, right? Alan, as you take a look at this chart, what really stands out to you with your trade in mind as you look at that chart?
So again, it's about risk reward. And as he pointed out here, 80 is a midpoint support of this action we've seen over the last year between 60 and 100. Oracle's not off its top, but it's still 30% higher over the last 52 weeks of trade. So I like where this stands, and I can lean on this level. The way I like to play, and we've done this before, is with some long-term options. So I'm looking at the September in-the-money call, the 72.50 call for September has 7 months, and it's got a delta about 70%. So what I'm looking for here is a stock substitution strategy. This option is only $100 more expensive than buying the July option, and you get 3 more months of time. Again, time is your friend. And if we get a halfway recovery in Oracle, like we've seen in the S&P, a halfway recovery of this drop from the top, that would bring the stock to 93, and this option would gain in value by 50%.
Final thoughts there, Rick? What do you think?
That's an interesting price level. I can see the reasoning behind that. That also happens to be right around our orange 63-day exponential moving average. So that's a pretty sensible strike price to choose based on this indicator.
Okay. Now let's take a look here at Cisco. I think Cisco is the next one on your radar here. This is one you talked about it being down 15% from the December highs. What are you looking at when it comes to Cisco?
So what I'm looking at, it's down 15%, but it's still up 15% for the year. This is a stock, again, trading somewhat sideways. We can lean on the levels. It's been between 45 and 65 for the last year. It's right here at this 55 level, which is also the 200-day moving average. So this is a a midpoint support to lean on. Looking at a July call, again, in the money, I typically go with a delta of higher than 70%. So the July 50 call is trading for about 7 or so. It's got 5 months of time. And if we get back to the 60, that option will gain 50%. So it's about the math. You've got time. And I like the risk reward on this stock as well.
Okay. And your thoughts, Rick Ducat, as you take a look here at 54.69 today. Your thoughts, Rick?
Yeah, 55 around there is a level that I highlighted on my own chart here because Ellen, I believe, was looking at the 200-day moving average. I was looking at the 252 exponential moving average. So that's right around 54.50. Our volume profile point of control is right around 55. So if you recall, that's the area of heaviest trading according to volume profile. It can often be an important level of support or resistance as bulls or bears respectively try to defend their positions or view it as an attractive entry point because it could be viewed as some idea of fair value given that this is where such a heavy concentration of trading has taken place around this level. Looking at point B to the upside could be some resistance around the 58 level. That's where trading starts to thin out a little bit. That's above our value area, those two yellow lines, which are 70% of the trades during the given time period. And point C, once again, volume has really been very slight more recently, which kind of tells us that perhaps there's not a lot of conviction in the market right now. We're kind of just drifting sideways. People may be staying on the sidelines waiting for some kind of breakout in order to deploy their funds.
Okay. And then, Alan, I wanted to get, before we talk more about your next one, which is Intel, why did these names pop up to you? Are these names that you've followed, you follow all the time? Is there a certain love for old school tech here?
Well, I'm old school tech, so yes. And I do like the share prices play into the payoff that a small move in the underlying stock produces big gains in the right options. If you're going to trade, the Microsoft or the Apple or the Google, obviously they're higher share price stocks and the options are going to be much more expensive. I like the payoff on these plays, and they used to be big components in the NASDAQ. And so they're going to follow with what the overall market does. This is a cheaper way to play tech, in my opinion. The easy way would be to go into the Qs or trade some of these ETFs that track these sectors. But these are stocks that I think sometimes get forgotten about, but they're still a big part of technology.
Oh, without a doubt, no doubt. Yeah. And so that being said, let's focus on your last one, and that is Intel. I know you were looking at the chart. Of course, it's had a downward move over the last year, but you were looking at the double bottom. Tell us a little bit about it, Alan.
There's a lot to like for this chart. Now, again, I'm not trying to pick this exact turn, but I'm talking about in the next months or 6 months or so, good things to happen. So from a risk reward standpoint, this is a great stock. It's out of favor. The PE ratio is 9. All right, 9. So it's an inexpensive stock in relative terms. It's been stuck between 40 and 60 for 5 full years. It's down 30% from its year-ago high, and it's down 15% in the last year, whereas the S&P, which is a better comparison, is up 15%. So double bottom, and now it's consolidated between 50 and 60 for the last 8 months, roughly. We're a little bit below it right now. A breakout of the range targets 70. So what I'm looking at is a September option, again, 7 months of time. The 42.5 call, trading about 8 or so, 850. It's only $50 more expensive than buying the July option. So when in doubt, buy more time. And if we get back to that 55 midpoint of this recent range, the option gains 50%. Again, small moves, big gains if using these in-the-money options.
Okay. And Rick, take us through the technicals here. Your thoughts on Intel.
Sure. And out of favor is definitely a good term to describe what's been going on lately with this name. We were making new yearly lows just recently, and it's looking like in the past few weeks we've established a range. The lows of 46.30, the highs of around 50. So that's kind of where the guidelines in the road are here for a potential breakout. So Alan's final price break even around 51 makes sense to me as well. That would be just above the point of our range. That's also where we've got roughly our 21 EMA and our 63 EMA. So those would be some key resistance points to overcome going forward in this name. Once again, we've got our volume profile point of control, which is near about 54, as well as our 252 EMA. So that could be a potential stopping point if the trend up starts to break out and give some price action to the upside. Finally, point C, that's the lows. Go ahead, Nicole.
Yeah. No, and so, I mean, my final thoughts begin as we look at all these tech names, which sometimes come under pressure when we see rates on the rise, as we've been seeing. Alan, I wanted to get your final thought because people are waiting for the Fed to raise rates, maybe even 50 basis points. You know, how's your mantra of trading maybe going to change?
Well, optimism wins, and we all know there's going to be a rate hike. The rates have to rise because they're at historically record low levels. And if you look at the futures markets are pricing in some hikes. And look at the end of 2024, they top out at 2%. And if you look all the way to 25, zero hikes, all the way to 2030, there are zero hikes in the pipeline. So, you know, this is still historically super, super low levels. And I want to point out, if you look at some of these big tech companies, they have tons of cash on their balance sheet. Guess what? They're going to start to get some yield on that cash. So that'll help them. Great profitability last quarters. I cannot say enough about the positives. GDP, jobs, profits, profit margins, low rates, and let's not forget wages. Wages are continuing to climb. And yes, we have prices reflating, but if you look at historical terms, they're not taking out historical highs. We've just had a big jump from 2020 dismal, dire lows. Now we've had a big move in the last year, but that's a percentage thing. It's not an actual price thing. If you look at prices, crude oil right now at below $100, if you adjust for inflation, crude oil in 2008 highs at $150 would have to be $195. So we're still a long, long, long ways away from a lot of price.
Good point. Great to see you both. Rick, thank you. Great charting there. We appreciate it. And Alan Nuckman, bullseyeoption.com. Thank you both for the big three today, where we took a look at Oracle, Cisco,